This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone, and welcome to our monthly open house, which is a Q&A session, action-packed hour that we will be engaged in, not just stock symbols, but your questions. And as I scan the list of attendees, I'm just totally overwhelmed at the number of people that are coming in tonight. And even though we had a time change from 8 to 8:30, we still have people dialing in or calling in from Europe, so they're already in the wee hours of the morning. And for me, that just shows dedication for sure. So I will get right to it. We have a lot of former mentor clients. We have current mentor clients, future students coming on board who I'll be speaking with this coming week. And I'm also very excited to see just how the technical signals are panning out for us. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF. And if you follow along with my weekly market report, then this is going to sound very familiar because I leave my lines on the chart so that everyone can see how the signals worked out. And just last Friday, right after the close, I get on and I start recording at 4:01. And then Kenny Sweeney, I hand the file off to him, and he adds the intro, the outro, all that good music that you hear, and then we set it up in Constant Contact to be sent out automatically at 6 a.m. Eastern Time on Saturday morning. So if you think that this is accurate after the market closes, maybe now you'll understand why we have so many people inquiring about the mentoring and the coaching, because when I have a session with somebody who has hired me more or less as their personal coach, we're talking about these signals while the markets are open. So we get to trade these stocks as they send off their signals, their buy and sell signals. And that's why we do what we do, because the market has turned more technical now than ever before. Not to say that fundamental analysis is not to be followed. I think the fundamentals are very important, especially as we move forward. You want to make sure that you're sticking with companies that have earnings, or at least preserve some of their earnings. Now, again, the investors are going to be more of a buy and hold type of a strategy, where the traders are not just looking at the fundamentals to decide which companies to buy, but they're looking at the technicals to tell them when to buy, or more importantly, when to sell. Now, Bert, I'm looking at your name. I haven't spoken with you in years. Hopefully we'll catch up. I think the last time I saw you was when I was a consultant with Charles Schwab on the west coast of Florida there. Probably the last time I saw you. I'm looking at some of these names. Bruce, you're there. Craig and Dana. Wow, look at all these folks. Just Dave, I'll be talking to you hopefully soon. David Bernstein as well. And so as I go through the list, I know that a lot of you already know my style. But then again, as I continue through this list, I can see there's a lot of newcomers who may not know the language that I'm talking with regard to speaking chart language, right? So what I'm going to do is just kind of bring it back to the simplest signals and bring it to the basics. And then when we open it up for me to analyze your individual stocks, I want you to just take good notes. Now, I'm going to do this, trading checklist. I'm going to highlight this right now. For those of you who are listening to the recording, I have this recording. The recording will go out to the members. Let me see, why didn't this open up? Let's see, trading checklist, PDF file, there it is. Okay. Now, some of you, let me shrink this down because I'm going to give you all an opportunity to get a snapshot of this. Where did it go? Trading checklist. Hold on. I know I have it here. Hold on. Bear with me. All right, so I'm going to shrink this a little bit so that, where do? Here we go. Okay. Now, let me shrink it one more. There we go. Go ahead. For those of you that can't wait until the recording has been rendered, take a snapshot of this. Just do a screen grab. For those of you that have an Apple computer, you could do Control, Command, and then I think it's the number 4 key, and you could clip it. Just clip it and save it as a file. For those of you who have a PC, I think there's a print screen feature there. Just print the screen. Copy this. I'm giving you, here I am recording this. I'm giving you full permission to copy this, to share it. I don't care if you publish it. The reason I'm giving this to you now is because this is the way I analyze charts. And what I'm going to do as I analyze the markets and review, I will then look at your own stock symbols, and I'm going to be looking for each one of these signals. Now, again, remember, I'm embracing simplicity. So this checklist is going to look at each one of these topics that we have here highlighted in bold type, and I'm going to analyze that and more or less weigh the evidence. What type of candle are we looking at? Is it a bullish engulfing pattern? Well, if it's a bullish engulfing pattern, guess what? We're going to put a big check mark on the bullish column. Is the volume supporting a bullish move? If so, I put a check mark there. If any of these are showing a bearish signal, then guess what? The evidence might still be weighing in on the bullish side, but you have to consider the bearish signs as well. When I'm looking at a stock, and I'll show you some of the stock picks that we put out last week, this is what I go by. And if I'm giving a recommendation for my own self in trading my account or putting out a trade alert to find the next best candidate, I'm putting out candidates that are showing bullish check marks all the way down the bullish side on that column. And if I'm telling people I think this is a good idea to take profits and sell the stock, I'm looking at stocks that are showing check marks all along the bearish side. So that's basically my whole strategy right there, right? So again, let me, in review, look at the diamonds. Last Friday, here's where the market closed, right here. See this little, tiny little candle right there. See that? And I said, this is exactly what I said. I said on Friday when I was recording this, I said we have a higher low and a slightly higher high than we had on Thursday. So I said that defines what we know as a pivot point, right? So I said we have the pivot point. I also highlighted the drop in volume. Remember that checklist. What kind of candle is that? Higher high, higher low, smaller body candle, right? I said the volume was down, and I explained that is when the volume is going down as the stock is dropped, that's a sign that the sellers are slowing down, right? I looked at the divergence from the moving average. On Thursday, there was a wide divergence from that moving average. That's bullish. We looked at the stochastics, and it was just crossing with a buy signal, right? I even put this little tick mark down here. Look at this. I highlighted it. I magnified it. I did everything on Friday. I said, look down here. When that blue line, which is the indicator for the CCI, so when that blue line crosses the green line, again, keeping it simple, I said when that happens, it's a buy signal. You see that? Well, look what happened. The market gapped up today in a big way. Now, the market gapped up, and it did so on higher volume. Now, let's take a step back. This horizontal line right here is drawn from the highs back here on the 29th of April. When you draw a horizontal line from a high or a low or a series of lows, those are called flat lines, F-L-A-T, flat lines. When it's a line above the market, that's a flat line resistance. When it's a line below the market connecting those lows, that's a flat line support. The end of the line, this diagonal line, is my target. See, so guess what? Today, we hit my target. There you go. Looking at the Russell 2000, right? There we go. What happened today? Well, why aren't those lines coming in? Oh, there we go. Okay, look at that. Same scenario. What happened today? We closed exactly at resistance, right on that flat. And guess what? That was my target. We hit that target. Bam, another one on the plus column. The Qs, what happened? Right down the line. Is this incredible? Look at today's high. Today's high is exactly to the penny of that line that I drew here as resistance. And we closed to the penny on my target, the end of the line being that target. So we hit that target. What happened with the spiders, SPY? Same thing. I'm not gonna dwell on all these stocks. They're all pretty much the same. Hit resistance, hit the targets, volume is up, momentum indicators are still going up. Now watch this. Watch this now. This is very important. I said the VIX would drop. Come on, I'll get my chart in order here. I said the VIX would drop. Where's my target on the VIX? My target is the end of the line. Have we hit the target? No. All of the markets that I highlighted and forecasted hit the targets. The VIX did not, at least not yet. Now, if the VIX continues to go lower, and I think it will this week, you can see that the stochastics oscillator is still going lower. The CCI is still going lower, and there's support down here. So I do think that there's still some room on the upside, particularly for the SPY. Because why? Because the VIX is inversely related to the S&P. Now, if the VIX continues to drop, there's a good chance that the S&P will continue to go higher. So there is a possibility that we could break out of this resistance high. And then we run into a thing called role reversal. That's when a stock or an index breaks out over resistance, this former resistance turns into support. It reverses its role. On the Market Guys website, I have a very short video. I think it's 6.5 minutes long that explains role reversal. Just go to marketguys.com, click on the video tab. It's free. Go in there and watch that, and you'll understand what role reversal is all about. Now, so those are the markets. Now here's the thing. This is what we have to watch out for, particularly the Russell 2000. All right, go back to Russell 2000. The Russell 2000 is a larger group of stocks in the index, but they're smaller cap stocks, all right? So you don't normally see volume on this index like you would on the diamonds and the spiders as the ETF. This is the actual index. Now, notice how the Russell 2000 gapped up. Now, here's my test question. I'm going to go to the Q&A box. Who wants to answer this first? When we're using gap trading strategy rules, right, can anyone tell me what the percentages are for gaps? And I see there's a question, Ogden Ross. I will get to that as well. But who can answer the question? What are the, George says 80%, Mike says 80-20, Rick says 80-20, Robert says 80. You all have that 80 in there. Oh, okay, Paul Gregory was the only one that actually answered and then completed. Oh, a couple of other people just came in. Okay, 80% of the time gaps fill. Okay, I'm glad you know that, and please teach that. Teach that to as many people as you can. Now, what does that mean? 80% of the time gaps fill. When a gap forms like we see here, it's gone higher, 80% of the time the stock will eventually come back and fill the gap. Now, it doesn't do that right away. Sometimes it takes 5, 6, 7 days, maybe sometimes 7, 8 weeks. But the Russell 2000 is gapped up. Once the gap fills, and I think it will, so in other words, I'll draw one line, but I'll have to erase it because I don't want my charts to be messed up for next week's report. Eventually, I think the market will drop back, fill this gap, and then Grant has the other half of the gap fill rules. 80% of the time after the gap fills, it will then reverse and go the other way. So while some of you are more or less hesitating to get in because you're thinking, oh, the gap is going to fill, it's only going to pull back, understand that once this gap fills, or I should say if the gap fills, because there's a 20% chance that it may not, but if that gap fills, that becomes a very, very strong support level. So I would be a buyer anywhere in this area once this gap fills, because then I can count on an 80% chance of it bouncing and going higher. So I'm seeing strength coming back in the market. I'm seeing confidence come back in the market. I'm going to tell you right now, folks, and I said this on the weekly market report, there are no guarantees here. There are still a lot of fearful investors. There's still a lot of uncertainty out there with regard to, hey, what is the Fed going to do? What's the economy going to do? A lot of people still are scratching their heads going, how can so many millions of people who are now out of work go right back to work? Well, the facts are they may not go right back to work. They may collect unemployment for a while. It may drain the system for a while. But you know what I'm seeing on the other side of this coin? I'm seeing that, especially in our neighborhoods here in Central Florida, there are a lot of my neighbors that are campaigning to get people to go out and support all of those restaurants that almost went out of business but didn't, so that the community can show support for these businesses. And I'm seeing people just come out and just opening their arms and just embracing these businesses that stuck it out. So I've even had some people tell me, like Bobby Barnhill, I don't know if he's on the call right now. Bobby Barnhill owns a nursery in Chiefland, Florida. And he closed for a couple of days not knowing what was going to happen. You know, there's a lot of people that are now figuring out, hey, they really can't make me close my business. Hey, they really can't make me wear a mask. Now, whether you think you should or shouldn't, these people are saying, you know what? They can't make me go out of business because of a virus. I can go out there and fight. And there are a lot of people that are opening their business. Well, Bobby told me he is busier now than he has ever been, because the quarantine where people are staying home started to get a little bored. They started driving around. Now they discovered his business, where they never attended or even showed up on his property before. Now people are roaming around and he has more customers than ever before. So we could see a lot of sectors snapping back that way. You understand? So I'm telling you this, you know, my main reason is not to, you know, if you're a business owner, just open up your doors. Use your own judgment. Go with your heart on that. But I'm telling you that as investors and traders, if we are smart enough and we continue to be proactive enough, there's going to be huge opportunities out there for a lot of us, especially the short-term option traders. Okay. Now I'm going to review one stock. These are for the members because we have a lot of members. Last week, I put an alert out on a stock that we're very familiar with because we made money on this one, Mylan. We had Dr. Billy Price talk about this one when we had him as a guest not too long ago. Okay. We got in. Now watch this. Look at this, folks. On this day right here, remember the checklist I had. What type of candle is that? At one point, this was a hammer pattern during the day when I put the alert out, but it wound up closing to be a small-bodied, what they call spinning top, right? We had a long stretch of red candles, 1, 2, 3, 4, 5. That's known as a stale red light. That's bullish. We had a wide divergence from the moving average. That's bullish. We had a drop in volume on this day on the way down. That was bullish. We had the indicator actually starting to hinge on this day. And the CCI was actually starting to turn up on this day when we put the alert out. You see this? Well, look at this. This stock is up big time for us, especially the people that traded options on this one. This stock is now closing over the 20-period moving average. Now, if you're a subscriber, the one focus on what? Protecting your profits. Do not ever, please don't ever turn a winning trade into a losing trade. Aggressively protect the profits right now, and then you can move on from there. Okay, there was a question. Where did that go about the gap? Where is it? Where is it? Where is it? Oh, hold on. I just had to explain why here. Ogden. Okay. Now, was that on SPY or the Russell 2000, Ogden? Hold on. I think that might have been the Russell 2000. Let's see. Is that back here? Yes. Okay. I believe that's what you're talking about. The question is, explain why the gap of March 23rd is not filled yet. Here's the gap all the way down here. See? Well, it's easy for me to explain. 80-20. There you go. There's the explanation. 80% of the time gaps fill, not 100%. Now, this may fill sometime way out in the future, but it could very well be part of the 20% of the time when gaps don't ever fill. Remember, it's not 100% guaranteed that the gaps will fill. However, now that there's a gap above the market, oh, I gotta get rid of that line. Remember, I can't keep that on for next week. Okay, so now that there's a gap up today, we now use that as a stop loss level, because now it's going to act as support. Now, let's say you took a long position, all right, in whatever stock that has a gap way down below the market. Are you going to, if you bought in and you have a profit right now, are you going to just not do anything to protect that profit, even if it goes all the way down here and you're going to say, okay, well, I think this market could pull back 25%, but I'm willing to hold on because once that gap fills, it's going to go up? No, you don't do that. 80% of the time gaps fill, 20% of the time they don't, and that's just the facts. Now, in fact, I think I'm the only one in the world that's actually published the 80-20 rule, because it's based on my own research over almost 40 years, and that's just from my observation. If you don't agree with it, or maybe you don't even believe it, here's how I can prove it to you. Go back to any stock, or as many stocks as you like, go back and count the number of times a gap has formed. So like back here, okay, on this day, that was the 4th, and right here on September 5th of last year, the stock gapped up, right? Where would the gap fill point be? Right here. See that? 80% of the time the gap fill, it filled. What happened? The day after it filled, what happened? Hammer pattern, it closed higher. So if this is a red candle, close at the bottom of that red candle. Very next day, guess what happened? The stock started to reverse, and it did. Pull back a little bit, and then it went up big. Look, back here, right here. Here's a little tiny gap. See what I'm showing you? 80% of the time it fills. Well, it took about almost a week and a half before it reversed and went the other way. Look, I mean, here's a good one. Small gap. Let me zoom into this one a little bit more. Let me see if I can find that. Here, tiny little gap right there. See? Marabuso. That's what that is. No shadows on this one. A tiny gap. What happened? It filled right there. See that? 3 days later, it reversed. So here's my proof to you, right? Go back on any chart. I got to erase that line. Go back on any chart, or as many charts as you like, and make a column. Gap filled, check mark. Gap reversed, price reversed after gap filled, check mark. Do your own research, and you'll see 8 out of 10 times the prices will fill, and 8 out of 10 times after they fill, they will reverse. That's it. That's the way it goes. So let's do this. Let's start. Wow, we have a lot of people on the call tonight. I just want to do one check here because I want to see if Dominic is on the call. Hold on, because I want to talk about Dominic in a little bit. Is he on? Is he on? Is he on? Don't see him. All right, I'll talk about him anyway. It's good. All right, so here's what we're going to do. In the Q&A box, start typing in your symbols. All right. Wow, David's first one. All right, now here's what I'm going to ask you to do. Probably should have said this right away. If you type in a stock symbol, please tell me what your position is or what you're thinking about. Like Phil is asking me to look at the video, and I will. You're second on the list, Phil. He's telling me I have no position, but I'm thinking about writing a cash secured put. What do you think? All right. So that's what I'm going to do. So I can help you better if you tell me, Todd, see, or Francis, before you just put in stock symbols, retype that in there. Put Microsoft, and this is what I'm thinking. If you tell me what your intentions are, I can help you that much better, because if I know you're already in the stock, I'll know where to guide you with regard to risk management, where to set the stops. Okay. So David is looking at TER. Let's look at that one. TER. All right. Teradyne. Now he's looking for a put sale at 57 strike or lower. Now, for those of you that do not trade options, I'm going to change all this around and erase these lines. For those of you who do not trade options, when you sell a put, basically what you're doing is you're becoming an insurance company to someone else who may own the stock. So when you sell a put, what you're doing is you're obligating yourself to buy the stock from somebody at a lower price, right? So David is thinking about considering buying the stock at 57. Now remember, it's trading 60, 65. So if he wants to sell a put, I'm giving you a little extra bonus here. Let's say he wants to sell, well, it looks like the 57.5 strike. So here we go. If David wants to sell the June 57.5 put, he could get over $2 for that. What does that mean? Someone is willing to pay David $2.10 to buy the stock almost $3 lower, actually a little bit more than $3 lower. How great of a deal is that? Well, if you like to own the stock at that price, that's really a no-brainer, because someone's paying you to buy the stock at the lower price. Now, here's the best part about a cash secure put or selling a put. If the stock does not get down to 57.5 and stay there, then you just get to keep the money. You don't make a trade, you just get to keep the money. Now, David, if you take, I'm going to round down. Let's say you were to, if you were to get this, sell the 57.5s and you get $2, your cost basis would be 55.5, which would be right around that support level right there. See? Now, look down a little bit lower. What do you see there? There's a gap here, which could fill, but if it does, it'll act as support. And then there's another slight gap down here, right around 47, right? So what you have to do is decide, if I wind up buying the stock, how far down would I let it ride before I get out, right? Because you have to think of that as having the same exact risk as you owning the stock at 55.5, right? Now, let's look at the technicals. We'll go over our trader checklist. What kind of candle is that? That's a pretty long green candle, right? That's a green candle. That would be considered bullish. Is there a wide divergence from the moving average? No, there is not. Is there an increase in volume or decrease in volume? Well, that decrease in volume actually on the way down here as the stock was going lower. The decrease in volume, so it went from a high volume here to a low volume. That's telling us the sellers are easing up on the pressure. So that volume would be considered bullish. The lower volume is bullish. We do not have a wide divergence of that moving average, but look at the oscillators. We got this stochastics turning higher. That's called a hinge. And just today, look at this. We have a buy signal on the CCI. Now, I'm going to stay on here for a little bit, David, because this is the most positive thing. Look at the low from Friday. The low, let me erase all the line. Now you know where support is, okay? Let me get rid of, gotta get the right click on my mouse. There we go. So I'm erasing these. On Friday, we had a lower low than we had back here on the 1st of May. See, so we have a lower low. Notice the lows on the CCI and notice the lows on the stochastics. We have higher lows on these oscillators as the stock was setting lower lows. If there's nothing else that you remember on this call tonight, remember this. Positive divergences on the oscillators are more bullish than anything that you're going to read above the chart or even including the volume. So what I think could happen, and I wouldn't even wait on this, if tomorrow you get a chance to sell those puts on the opening, might be a good idea to do that. There's a good chance the stock is going to close over that 20-period moving average. Once that happens, then you could very well see a breakout of these highs, because let me draw this all over. What we're seeing basically, all right, I'll see if anyone else could pick this up before I'm drawing it, it's called the symmetrical triangle. It's when you take this high, connect it to this high, connect it out to this high, project out. You see that? Then I take this low, connect it to this low, project out. There's your symmetrical triangle. So there's a good chance you're going to see a breakout to the upside of that triangle. Triangle patterns are significant because it's those who have traded pattern breakouts before will tell you that when a triangle breaks out, you generally get a significant move. It could be up or down, because if you see back here, here was a triangle back here that broke to the downside. You see this? Here's a symmetrical triangle that broke down below, or broke out below, and it continued lower, right? So if you decide to sell the 57.5 puts, and it starts closing below this low right here, which would be a breakout below that triangle, David, take my word on this, just close out of the position, and if you have to take a small loss, do that. Do not ride a short put position on a breakout of a triangle to the downside. Do not do that, because it could wind up going all the way down to 40. All right, you follow me there? Hopefully that was a long answer to your short question. All right, Philip, here we go. Philip says, no position, thinking of catch and could put. I read his question to you already. Well, this is a little different now than what David showed us. David showed us a stock that was giving us bullish indications. All right, NVIDIA is not, and I can tell you that right away, because what we have here is called an evening star, right? This is when a stock gaps up, and it's doing so on lower volume. Go back to our trading checklist. Where is that? Do I have it? Right? Type of candle. Type of candle's evening star, that's bearish. We got to put a check mark there on the sell side. The volume, ready for this, is down when the stock is up. Is that bullish or bearish? It's bearish. Negative volume on the way up tells us the buyers are slowing down. We have a wide divergence above the 20-period moving average. That's bearish. We have a gap below the market. That's bearish. Stochastics is overbought. That's bearish. CCI is overbought. You see this? Now watch. Remember what I said about, I hope I'm not raining on your parade, Philip. I'm just trying to save you here, all right? Because that 350 put looks so appetizing, doesn't it, to be able to collect $50 on that, right? Well, watch. Remember what I said about the positive divergence being one of the most significant signals you can look at that overrides what you're seeing on the upper part of the chart? We have a higher price high, a much higher price high on a lower stochastics high and a lower CCI high. And I can even go so far back to here and draw it that way. See how the highs on the CCI is dropping? Well, the price is going higher. There's a good chance that NVIDIA is going to come all the way back to the moving average. So if you sell that 350 put for $50 and it goes down to 300 and comes back to that moving average, guess what, Philip? You're going to be losing money big time. Now, I would suggest that you find the stock that's got a little bit more indication as bearish than before you sell puts, because selling puts is a bullish strategy. So you don't want to be overlaying a bullish strategy in a bearish market, or at least a stock that's showing bearish signals. Okay, Doug, looking at TLT and watching my time. We still have a lot of time, folks, so don't worry. TLT bought this afternoon. Now, here's what you have to watch out for, Douglas. Historically, TLT and the spiders work inversely for the most of the time, most time. So if the spiders, as I said, have a chance of going out and breaking out to the upside, then chances are TLT, because you see spiders was up today, TLT was down. You have to be careful, because if you and hopefully if you bought TLT this afternoon, hopefully, you know, again, I don't want to rub salt in what could be an open wound here, but if you're following the checklist like we are here, you may not have bought it, because all of the indications on TLT were showing bearish all the way on the bearish column. I'll just run through it real quickly. Friday, it closed below the 20-period moving average here. There was a gap below the market that still wasn't filled yet. It came close here, right? You have the volume was dropping on the way up, right up until Friday. Remember, when the volume is dropping as the stock is going up, that's telling us the buyers are losing momentum. So all of that is bearish, including the stochastics and the CCI were turning lower, right? So what I would say, now that you're already in it, I would say set your stop. You need to put a stop in below these most recent lows, okay? So you got a low here of 161.48. If it drops another $2, I would be really careful, okay? Be really, really careful. Be defensive on that one, all right? All right, now let's look at Manix. Looking at SLV, I got an alert today on SLV because the volume, it was way above the moving average and volume was spiking. Now, I've traded silver. I cut my teeth on silver in the trading pits in New York, in the World Trade Center. I traded silver and gold. So I know silver. I've been trading silver for almost 40 years. And so I like silver, but what you have to watch out for is silver, unlike a lot of stocks, you don't have really any fundamentals to go on outside of, you know, what's happening at the silver mines. You know, how much inventory they have, you know, how much are expenses, how much is insurance, what's the cost of fuel to pull it out of the ground. You know, those are considered fundamentals. But SLV is not a company. It's basically a commodity, and SLV, the ETF, tracks the price of the underlying commodity futures price, the spot silver. So again, going to the checklist, if you bought 500 shares at 14.51, I would be all over that, taking a profit, even though it's a small profit. See, because you said you're going to sell it when it hits 17, or buy more if it drops to fill the gap at 14.80. Well, here's what I would say: use the checklist. All right, look, use the checklist. I'm not going to go back. Hopefully you got the screenshot. What kind of candle is that? I'll do it quickly. That's a spinning top. After it just filled the gap. Look, today, this Friday, it didn't fill the gap. It came close. Today, it filled the gap. And not only did it fill the gap, it exceeded and gapped up, right? So 80%, there's an 8% chance silver's going to drop now. I'm not going to say it's going to drop that far, but there's an 8% chance silver could drop now. So the candle is bearish. There's a wide divergence from the moving average. That's bearish. You have a drop in volume on the way up. That's bearish. You have gaps below the market. That's bearish. You have the stochastics hinging lower after being overbought. That's bearish. CCI hinging lower after being overbought. That's bearish. Everything about this, there is nothing on my trader checklist, nothing that shows bullish, nothing. Hence the reason why I say it's a good idea to either trail your stop to the low, right below today's low, or get out, or I'm going to give you a last choice that kind of puts you in a win-win. How about you sell half? Sell half the position and trail a stop on the other half just below Friday's low. There you go. You're in a win-win. If it keeps going higher, you still have half to make profit from, up to 17. If it drops, what have you done? You've created more buying power for yourself. So now when it gets back to 1480, if that's what you think it's going to do back here when it fills the gap, now you get to buy more because you created more buying power. See, put yourself in a win-win position. I love win-wins. And you're actually in that position right now if you handle it correctly. And our regular follower, I don't know if you've missed at any open house sessions, if at all. Ann has been a regular. And I don't see the stock symbol, though. I see a comment bought at 238, or is there more upside? What are you referring to? What stock symbol? Let's see. I know there's a delay. I'll wait for Ann to put that in because I do want to help her out. What did you buy at 238? Yeah, there's a real delay. And I'll put you on the side burner. I won't put you on the back burner. I'm going to put you on the side burner and get back with you after I analyze Microsoft for Todd. MSFT, we're making a lot of good profits on this one for the option traders, all right? But here's what's happening with Microsoft. Remember the checklist? We have very little to go on with Microsoft because it's almost neutral. You see the oscillators down here are kind of mixed. You got stochastics in the middle of the road, CCI not quite overbought, at least not yet. We have a small red candle up here. See, in my opinion, with the way the Qs stormed up today, Microsoft should be off the charts. So even though Microsoft is up $1.75 today, it's not even up 1%. Okay, when the Qs, again, look at the Qs, Qs up almost 2%. You see? So I'm surprised that Microsoft didn't gap up today, right? You think, again, if all markets, all indices are gapping up, why did Microsoft wind up with a red candle today? See, although that's not telling you buy or sell, I'm just looking at this. I'm saying, well, Microsoft has a small spinning top. It's at resistance. The oscillators are floundering, and we have a drop in volume on the way up. So the drop in volume on the way up over the past 3 days is telling us the buyers are losing momentum, you see? So I don't get too excited about that because you have this most recent resistance. You have this resistance up here, and then you have another resistance from the highs back in February. So you got nothing but resistance above the market right now, and Microsoft did not react in a major way to the upside when the rest of the markets were, right? Francis is looking at Alibaba, BABA, right? This is another wildcat. Now here's a stock that did gap up. So, Francis, I'm looking. Okay, Todd, you just put in what your intention is. You're looking for a move higher for the May 22nd. All right, just be careful. Again, I don't see any major bullish signs. If you're already long it, I would say protect it. Now, Francis, I do not see what your intentions are with Baba. Let's see. Did you put it in afterwards? Okay. I see you have another stock there. Let me see. No, I don't see. All right. I'm going to look at Baba anyway. All right. Checklist. What do we got? Well, immediately my gut's telling me you might have a little bit more upside because of the increase in volume. See this increase in volume on the way up? That's bullish, right? Even though it gapped up on higher volumes. So that's telling me the buyers are motivated. However, look, we're hair away from that resistance from back here on April 20th, where we had a bearish engulfing pattern back here and then an inverted hammer right here. So you are a hair away from resistance. So here's what I would tell you. Be watchful of the volume. In other words, if the volume drops tomorrow, if you get a lower volume, then all bets are off for any new longs or any existing longs. If you get a drop in volume, then there's a good chance it could do this: fill the gap and then bounce, because the gap fill point will act as a support level. Why? Again, because 80% of the time after a gap fills it, it reverses. So if the gap is to the downside and the gap fills, it will reverse, and this will act as support. So if you're already long the stock, you get a long way down. I mean, that you still have $13 to the downside before that gap fills, right? Sheldon, we looked at NVIDIA, NVDA. Did you have another question on that? Because we already talked about the weakness and the possibility of a pullback. If you have any other comments or questions about that, just type them in, and I will go to the bottom there. Okay, NCLH. I don't know this stock, so let's take a look at this. Again, this is NCLH. Norwegian Cruise Line. All right, this is a tough one. Not from a technical standpoint. It's a tough one because I still don't know what's going to happen with these cruise lines. I just don't know. I mean, there's still so much fear out there with this COVID-19 scaredemic that I just don't know how long it's going to take for people to hop back on a cruise ship. I mean, the only thing I could say at this point is that you got to keep an eye on the airlines first. Here's why. Think of the psychology behind this. If someone has to travel for business or is looking to travel for a short period of time to visit a loved one or some family member or friend out of state, they're going to be carrying the same fear as someone who might decide to hop on a cruise ship. But remember, the cruise ship is a vacation / luxury, trip. It's not a destination where they have to go see somebody or have to travel for business. So if the airlines are still suffering, then chances are the cruise lines are going to still suffer. So I'm looking at the airline stocks as a leading indicator for stocks like Norwegian Cruise Line or Carnival Cruise. You got I think CCL. See, they're all looking very similar. Okay, CCL, the Carnival Cruise, is looking very much like UCHL. Oh, come on, there I go. I just typed in the wrong one. Well, you get my point. It's going to be a leading indicator for the Norwegian cruise lines. All right. So what I would say is you just have 200 on there. I don't know what that means. NCLH 200. I don't know what that means, 200. But if you're looking at buying this stock, understand you are in a symmetrical triangle right here. See this? And if it breaks out of this upper triangle line, you could see higher prices, but I certainly don't think it's going to go to 50 overnight, which is where the gaps are up there. So be really, really careful. Okay, George, I'm going to you right now with FTNT. FTNT is Fortinet. Is that Fortinet? I don't know this company, but technically I could look at this. You said you got in at 114.5, got a nice profit, have a 26% profit, and have a 15% stop loss. I don't know what the 15% represents on the stop loss side, if you're basing that 15% on the share price or based on what you have in there as profits. I don't know, but let me just give you an actual dollar amount to look at. Number one, stock is up. Let's use the checklist. It gapped up today. It gapped up. On the opening, it was trading up here, right? It opened on the high, closed very close to the low, and still has a gap. Let me see how much of a gap that is. It got as high as, on Friday, it got as high as 144.03. Today's low was 144.05. You have a 2-cent gap still down here to be filled, right? So you have a negative candle, check on the bearish signal. You have a wide divergence from that moving average, check on the bearish signal. You have a gap below the market, check bearish. You have a red candle on high volume. It has not pulled up. This tells me this high volume is known as a buying climax. That's when they battled it out at the high. That's actually a negative sign. It's not like what we saw before, where if this were a green candle on low volume, that would be bearish. This is a high volume candle on a very negative red candle up here. You have a negative divergence on the stochastics, and you have an extremely negative divergence on the CCI. Everything about that tells me watch out below. So hopefully you will. If you've got a $30 profit in this, which you do, you have $30.17 of profit. I would protect the heck out of that profit. And guess what? Even if you sold out of all of it tomorrow, even if you sold out of all of it, chances are the stock is going to give you a chance to buy it back. Maybe not all the way where you were at 114.5, but chances are it'll give you a shot to buy it back cheaper where it is right now. So that's the analysis there. mRNA. Let's take a look at that one. mRNA. Oh, sell it. Well, that was my my knee-jerk reaction to the technical signals. You got a big red candle up there. Big red candle. Gaps below the market. Wide divergence over that moving average. You got a negative. Look at this. This is incredible. You have much higher highs on the price here. See this? The overbought condition back here started April 3rd when the stock was trading around 35, right? It's up around 80 right now, and the stochastics is lower than it was back when it was trading 35. That's alarm bells. Alarm bells are sounding on that negative divergence. You got a gap below the market, bearish. Wide divergence from the moving average, bearish. You got, similar to the other stock, we have a buying climax. Something happened today. I don't know. There must have been news that was released because there is a super high volume, highest volume all year, and the stock gapped up tremendously and then started selling off towards the end of the day. If you look at the intraday chart, look at this thing. Started off pretty good. By the end of the day, it wound up low. After markets, it's even lower than what it was. Now it's down below 80 in the after-hour sessions. You see? So it dropped $2.10 after the close, right? Is that a guarantee it's going to go lower tomorrow? No. But what does that mean for you? Well, you're saying that you haven't bought it yet and you're too afraid to get in now. Am I too late to the party? I mean, again, this is a tough position for me because I'm not an advisor. But if I were the charts talking to you and I'm using my trading checklist, I got every signal on that daily candle chart. Every signal is pointing lower. Now, for those of you that are not trading this stock or any of the stocks that I've mentioned, this is recorded. Okay, this is recorded. I certainly hope that each and every one of you get your hands on the recording and listen to it next week while you have your charts in front of you. You can look at the recording. You can see how I pointed out a negative divergence. You can see how I drew a forecast line, right, to fill the gap down here. You'll see all that. And what I want you to do is do your own scorecard on me, right? I want you to score me in the way I'm interpreting the charts. I will never in my lifetime be right 100% of the time. But when I trade, I actually have to assume that I am going to be wrong. That's how we have to trade. It's kind of like the Mylan, right? Is it MYLN? Excuse me. Oh, come on. MYLN. There it is, MYL, excuse me. It's kind of like Mylan. When I put the alert out, okay, on Thursday, I told everyone to put their stops below this support level. Why? Because even though the charts are right most of the time, they're not right all of the time. So again, this is just good advice. If you're trading, you have to assume you're going to be wrong, hope that you're going to be right, and protect your account as though you are going to be wrong, right? And then when you use the 1% rule, and when that time comes when you're forced to take a loss, you're only going to give back 1% of your account. By the way, for those of you that don't know my 1% rule, that's on the website. Okay, if I have a video on there, it's gonna say 1% rule for managing risk. Go on there. It's 7 minutes long. Go ahead and watch that, so you understand what I'm talking about with regard to the 1% rule. Okay. Okay, mRNA. I just got a text message from Dr. Price. mRNA. I'm going to look at this here for a second. mRNA. Billy, are you on the call here? I didn't even see your name up there. Let's see. Yes, you are. Okay. All right. So mRNA, Moderna, all right? This is what we're talking about. Dr. Billy says their research, although good, was only about 30% developing. Was only about, all right, 30% developing significant antibody levels and not sure of neutralizing levels. All right, thank you, Billy. So that's coming from Dr. Billy, who we talked with last month when he was giving his professional opinion on a lot what was going on in the pharmaceutical sector. So technically, you got that possible pullback, and then fundamentally based on the news, that's what's affecting the price of the stock. Okay, so hopefully that helps you. All right, let's see. Robert Kelly, I think we talked about SLV already. Hopefully you won't be doing that until the pullback. All right, Todd says Microsoft on the 185 calls. Oh, okay. Todd, I sometimes cringe when I hear people buying front month calls, but let's look at that for a second. All right. Are you on? I don't know. If you're long at the money calls, I'm just telling you this right now, Todd. Be prepared for time erosion, because at the money, front month calls have the highest theta. That's the Greek variable for time decay. That theta is the highest out of all the options on the board. So be really careful. Time is not on your side with this one. If you're long the May 22nd 185 calls, you do not have time for this stock to just sit there. It either has to go up or you have to go out and limit that loss. That's it, pretty much. All right, Dave, welcome. Dave is looking at CODX. All right, CODX. There's a lot of people that get on these calls and just with a pen and paper just take notes. They don't even say anything. They just take notes and look for good trade candidates. Now, here's an interesting stock, right? Dave is long this one. I don't know where you're long it, Dave, but the oscillators are looking neutral. However, look at this. This is interesting. I'll get a chance to talk about this. See this high back here that was tested again right here? If I draw a flat line right across those and connecting pretty much this to this high, this is a former resistance level that was broken. And notice this. I'm going to zoom in a little bit more. There's a tiny little sliver of a gap right here. It almost filled. I would say that's close. Let me see. I got to see if that filled exactly. On that day, May 8th, the high was 1565. What was the low from Friday? 1580. It's 15 cents away from filling the gap. It didn't fill it, but it came pretty close. But here's the good news. The stock is dropping and the volume is dropping significantly. You see that? So if you're long this one, I wouldn't say you did a bad thing. And I'm not saying today's the day it's going to pivot, because it still might come all the way back down to fill that gap and then bounce. But the good news for you is that the volume is dropping on the way down. I see a little bit of a hinge on the CCI, but it did not get oversold. You see that? So once the CCI starts going up, that'll give you some indication that the bulls are starting to move back in. But I would say keep your stop somewhere right below the 20-period moving average, which is right around 1535, and leave it at that. Okay? I just looked at the clock. We're right at the bottom of the hour. I cannot believe how fast that went. I want to tell you something. Dominic Boyle, I don't know if he's on. Is he on? Is he on? Is he on? I don't see him. But I want to make an announcement. For those of you who watch Fast Money on CNBC with John Najarian and Pete Najarian, I'm good friends with John. In fact, John and I go way back. He was one of the first guests I ever had on my PBS show. He and Pete are regular contributors on Fast Money. They, along with Dirk Mueller, the third partner, have a company called Market Rebellion, and they have agreed to pick up my trade alerts, and they're going to market my trade alert services. And so we might go through a little bit of a rebranding on the name of that, but we are moving forward. It's looking like the first week of June, they're going to make that available. And the reason I tell you that is because we had so much good stuff coming down the pipeline where we're going to start doing some group mentoring / coaching. We're going to be offering live events. We're going to be offering webinars where we converse. John and Pete and myself are going to be going online and having these live webinars from remote access, locations. It's going to be really, really good. So stay tuned. And please tell your friends and anyone you know who is connected to the markets in any way to plug in. These webinars that I do each and every month are absolutely free to the public. We do not charge money. My goal is to help as many people as I possibly can make money in the market. It's one of the best markets I've seen in my entire life, in my career, and I think it's only going to get better. We're sticking to the technical signals because the markets are following technical signals. As more and more people remain confused about the fundamentals, or maybe no longer trust the analysts in their earnings forecasts, we have the charts that we can count on, because the charts are nothing more than a representation of past price action, and we can gauge entry and exit points from those signals. So thank you so much for joining in. I hope to talk to you again soon. And for now, I'm going to sign off. Thank you. Bye-bye.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.